Let's go over the macro drivers that signal a broadening rally in 2024. Hey, everybody, we've got a lot of new YouTube subscribers. Thank you for that. We are trying to bring unique content to this platform. If you're new to our channel, make sure to like and subscribe if you enjoy what you see. But let's go ahead and get to it, right? 2023 was all about having tech in your portfolio or not. Basically, if you had a lot of tech stocks, you outperformed. If you didn't, you probably underperformed. Now, 2024, we expect to be a little bit different, where more participation is going to happen in the marketplace, right? So a lot of unloved areas. Now, before we get into the macro drivers, let's go ahead and look at this awesome illustration. And it's basically telling you how certain areas of the market have performed since Treasury yields peaked. So this is October 25th, 2023 to present. Got one big red bar here. That's Treasury yield. So 10-year Treasury yield is down almost 20%. When yields go down, right, that helps stocks, right? You can see that the S&P 500 growth, it's up 11% in that time frame. S&P 500 is up almost 14%. The equal weight S&P 500 is up 15.5%. S&P 500 value is up 16%. That's probably shocking to people. People have been betting on value for a long time, getting smoked. Well, they might be having their day. And then you've got the S&P small cap 600, which is up, almost 20%. If you guys can remember, the crowd said small caps were dead. Map Signals a few months ago said that's where you want to put your chips. And lo and behold, we are seeing a magnificent rally. Now, the verdict is out, the jury is out, wondering when are we going to have the rate cuts. Alex says it doesn't matter when we have them. It's just that we are going to have them, right? And then more importantly, knowing that rates are coming down and looking at the latest macro tailwinds, we believe earnings are going to accelerate. And this chart really tells you why. So here he's looking at productivity and falling wages. Okay. So here you got a bunch of lines. You got the blue area here. This is telling you labor productivity is up, right? So you got more people working, more things are getting created, right? Then you've got this red line, which is showing that labor costs are actually going down. And what do you think that is going to do to net income? Well, it's going to go up, right? And whenever net income goes up, right, your margins are better. That means you're going to have more earnings. And so you guys know it's very simple. When earnings go up, the stock market does well. So this is the first macro driver that is signaling a broadening rally, because we believe higher margins going to flow through to a lot of areas in the economy. Now, here is the best part, and you guys know we're all about historical studies here at Map Signals. Since 1950, when productivity is up big, which is what we just witnessed, the S&P 500 rises an average of 12% in the following 12 months. You can see that here with this beautiful 12% bar. That is telling you that you can expect a market-beating average 12-month return with productivity this high. So bears might want to start hibernating. So the $1 million question that most people want to know is, how do you play this, right? You guys are all bulled up. You've been bulled up for a long time. Well, let's go ahead and look at the 2024 S&P 500 census EPS forecast. Wow, it's a lot of words, but basically we got all the sectors, which ones are going to likely grow their earnings the most. And you can see by and large, it is one of our favorite areas. Our latest video actually is telling you why we like healthcare, but this is the main reason. Year over year earnings are expected to go up 17.5%, even more than technology, which is nice, at 16%. Now, with interest rates coming down, margins are going to expand. That means more profits, more money is going to fall to the bottom line of these two areas. So those are a great way to play that. You could find some of these big ETFs to play. Healthcare, maybe XLV is one. Technology, maybe it's XLK. Let's keep going, because we are all about data here. Whenever you look at our sector ranks by MAP score, it also echoes the earnings growth. And that's very important, right? Institutions are positioning very heavily in healthcare. And we can see that with the MAP score. Healthcare has the top MAP score. and it's got decent fundamentals and strong technicals. A lot of money's been going into healthcare names, and basically that's because it was left for dead in 2023. And then number 2, you guys know we've been very constructive on financials. And number 3, technology is doing very well. You can see that it actually has one of the strongest fundamental rankings in all of our data. So these are just some great areas that you can play for the broadening of the rally. And then let's not forget there is something really special going on in 2024, and that is we are at the final rate hike, right? You remember we had our final rate hike in July of 2023. Well, check out, what do you think the 12-month best performing sector is? The final rate hike, and it's financials 30%, and then here we are, healthcare at 29%. You guys know, very bold up about healthcare. Got this data showcasing that it's a good bet. We've got other reasons suggesting that it's a good bet with money flows and higher margin story. Let's bring it all together. What can you be doing? Well, you can be looking for some unloved areas of the market. Make sure you focus on stocks that are growing their earnings, growing their revenues, guiding higher this earnings season. That is how you're going to outperform. Again, if you like this type of content, you find value, make sure to like and subscribe, and we'll see you next time.